Hello, Gold Bull investor, and welcome back. You have probably heard that it's one of the most dependable methods to create long-term wealth from the sophisticated sorts with their portfolios of profitable equities. And you want a piece of the action. But how do you get started? Yes, starting may seem complicated and even daunting, but it doesn't have to be. We'll discuss the top 10 pieces of advice for beginner investors. It could help save you from making the same ones. Welcome to Gold Bull, the place where future successful investors gather and get inspired. If you have not subscribed yet, you are missing out. Alright, let us dive in. Number 1. Start with your personal finances. We hear you. You're eager to start building wealth, and we're urging you to do so. But if your personal finances aren't in order, first, deal with them. This means that if you have significant interest obligations, you'll pay more in interest than what your investments will return you over time. For example, if the stock market returns 10% each year, then you should expect a 10% return from equities. If you have credit card debt, chances are you'll be paying higher interest rates on it. You should also get rid of any debts before starting to invest so that you may have an emergency fund that can cover your living expenses for at least 3 months or more if needed. Your portfolio's there to build you long-term wealth, and if something bad happens, the last thing you want to do is to have to sell it to cover your day-to-day expenses. Number 2. Never invest in an industry in which you are unfamiliar. This is a simple guideline to adhere to. If you don't know how it works, don't invest. Do your own study and don't let someone else do it for you. Never trust fast-talking salespeople who entice you to send them your money and leave it to them thinking, "Oh yeah, it will work out." No, it won't until you do your own research. This is not a time to be fooled by others who are raving about the next big thing. If everyone is talking about it, the moment to invest has surely passed. You'll have to conduct a lot of research and reading. Number 3. Write down your investment goals. Sure, we all want to become wealthy. However, an investment goal must be more precise. It's important to have a specific time in mind in order to be successful. It should take some time to become wealthy. Realistically thinking, decades rather than years is the best chance for accumulating wealth, but that doesn't mean shorter-term possibilities don't arise. You might select stocks that have a negative value, which means they're currently valued at less than what you paid for them, and then wait for them to rebound. It could be very difficult. It involves more knowledge and experience to get it right. You should set a specific amount you want to start investing in on a regular basis. It's impossible to name a number or even a percentage of your earnings because this is determined by your present situation and long-term objectives. But it's fine to start modestly and build up. Number 4. Grasp your own attitude toward risk. Consider this early on. It will affect the types of equities or other options you'll want to invest in, and whether you prefer to play it safe or live a little dangerously. When deciding which stock to buy, keep in mind the golden rule of finance. The higher the risk, the greater the potential return, and of course, the higher your chances of losing it all if it fails. Regardless of the outcome, you'll most likely want to assemble a portfolio that contains both safe and risky investments with more potential for development, depending on how you feel about risk. Number 5. Begin educating yourself about finance. When it comes to investing, knowledge is your friend, and now is the time to start learning. This is something you should start working on right away. Whether it's buying or selling, you'll want to be exploring new areas and keeping up with the market. Start reading the financial news. Choose some stocks that you can track as they move, and learn everything there is to know about them. Join online forums where individuals discuss equities, cryptocurrencies, and commodity rates. As a result, you'll be more informed about what's going on in the world and how it affects you. Number 6. Learn the basics of analysis. This is a crucial tool in your financial education. Take a look at any finance app or website that includes stock listings and examine the long table of digits that usually appears just below the graph. Does it appear like an alien language? Or can you make a sense of it and get a picture of the firm's current performance? If you can you decipher this? You'll learn about subjects like dividends and regular dividend payments, which not all firms pay. Dividends are usually paid out a certain rate of frequency, but they're not always a good thing. Some that do pay them tend to be older and more established companies. Consider Coca-Cola alternatives that aren't always younger and more innovative, but steady growers. On the other hand, Tesla or Netflix, Facebook, now the metaverse, or some ETF like ARK Invest that it's typically riskier, but keep in mind that it also opens up more possibilities for development. For growth too. The price to earnings ratio, or the company's total stock value divided by its income over the past year, are two of the fundamentals that are utilized to assess a firm. And just because it's high or low doesn't necessarily imply it's good or bad. You need to put things in perspective. A high PE ratio suggests that investors think the stock will rise, while a low number implies it is a more established business. It may be a bargain, but it can also mean that it's not. The numbers are meaningless on their own, so you'll need some expertise. But once you've got the fundamentals down, it's not that difficult after all. Start learning about fundamental analysis and how to utilize those figures to assess a company now, rather than later. Number 7. Pick a broker and be aware of fees. If you want to invest in stocks, the first thing you have to do is pick a broker. Of course, there are going to be costs involved. Therefore, before purchasing any stock, shop around and compare rates, since these expenses might negate your long-term gains. The fee charged by a financial broker to manage an investment account might not seem like much, but it can add up over time and may cost you a lot of money. Other management charges may be present in some investment accounts, as well as other expenses that you don't want to pay or pay less than 1%. Number 8. Find the best strategy that fits you. Between two extremes, you may buy for the long term and wait for the value to rise in line with the stock market. Or if you've picked wisely, then beat the stock market. That's a buy and hold strategy. On another hand, you can do short trading, which is when a trader sells to make a quick sale to generate short-term swings in a matter of days or weeks, which is known as active trading, or really short-term day trading. The short-term strategies are considered riskier. Long-term strategy buy and hold is used by most successful investors, and it also applies to crypto. Of course, this involves a long-term buy and hold approach. That's not to say you'll hang on to everything indefinitely after investing in stocks. You'll read the annual reports and examine quarterly earnings statements, and pretty soon, you'll learn all about the basic analysis and be able to stop the warning signals that it's time to sell. But the most reliable strategy is long-term buying and holding. Number 9. Not trying to time the market. Isn't it wonderful if you could travel back in time and buy a lot of Bitcoin at a low price? You'd be very wealthy right now. But that's just a daydream. However, this is something that investors do all the time. What makes you think you'll get it right when so many professional fund managers always get it wrong? When it comes to your stock's price, for example, there will be longer periods of time when the outlook looks good or bad for a specific investment, implying it's time to buy or sell. Trying to time it precisely is extremely difficult and likely to end badly. This is why short-term methods are hazardous, while long-term methods are far more effective. Number 10. Remove the emotion from the equation. When emotions enter the picture, you risk doing things like panic. If you'd remain calm, you could have just written it down and waited for your assets to return to their value before selling when they begin to drop. When everyone's talking about investing in a new major thing, such as electric vehicles or blockchain technology, it's easy to be fooled. The chance of investing might have already passed. Keep in mind that great investing isn't always exciting. If you're having fun, you're probably not making any money. As Warren Buffett has said, if you're looking for a thrill, go to the casino. Hey Gold Bull investor, which investing advice did you find the most helpful? Let us know in the comments. We've got a bonus for you since you've stayed with us until the end. Yes, here you go. You might watch the following video as it may be helpful in your investing journey. We hope you enjoyed this video and found it useful. We want the very best for you in your investment endeavors, so don't forget to subscribe if you haven't already for more high-quality content updated 4 times a week. Alright, see ya!